What's up, guys? Jake here. Potentially in the next couple months, the stock market is going to get a little volatile, and what people are going to be talking about is something called tapering. For example, in this article, Federal Reserve preparing for taper this year, July minutes show there's growing support within the Fed to announce the tapering of bond purchase in September. What the heck is tapering? Well, I Googled it and Google was not very helpful. However, I feel like I understand the issue and I'm going to explain it for you in this video so you know everything you need to know about tapering. And tapering is just the undoing or the opposite of quantitative easing. Whatever the Fed is initiating in a brand new policy, they've got to come up for a fancy word for it, and for some reason they came up with tapering. Now you might be asking, what the heck is quantitative easing, Jacob? Well, to understand quantitative easing, the Federal Reserve is basically an independent agency given a mandate, and that mandate is twofold. One, stable prices, basically to control inflation. Their goal is for inflation to be between 1 and 3% a year. That's indicative of a healthy economy. Two is full employment. They want the unemployment rate to be as low as possible, but basically close to 3% and you're at full employment. They don't want employment going super high to like 8, 9, or 10%. And the Federal Reserve basically has two levers of control for monetary policy. The first one being the federal interest rate. This is the rate that commercial banks like Bank of America or Wells Fargo borrows money from the Fed in order to loan out to you. They loan this money to you as an auto loan, a business loan, or mortgage. Now, the federal interest rate is currently at 0%. It fell to zero after the 2008 recession, started going back up, but thanks to the pandemic, back to zero. So what can the Fed do if interest rates are already at zero, other than offering negative interest rates where they pay banks to take their money? They can start buying assets, and this is quantitative easing. This is what the Fed is doing to increase the amount of money in circulation if nobody wants to borrow their money for free, basically. You've all seen this hilarious meme of Jerome Powell going burr with the money printer, but how exactly does the Fed print money? And they do this by cooperating with the U.S. Treasury Department. Anytime Congress spends money that it hasn't collected in tax revenue, which is every year, they have to issue government debts to anybody willing to buy it. And they have to offer an interest rate to incentivize people to buy government debt. And they do this all the time, every year. And the Federal Reserve is basically showing up with an infinite checkbook, money that doesn't exist anywhere, and they're buying U.S. Treasuries. They're buying all the U.S. Treasuries. And it's not actually just government bonds that they're buying. Since the pandemic, they've been buying corporate bonds, and they've also been buying mortgage-backed securities to prop up these markets. And the total bond market is supposed to have normal market forces driving interest rates, supply and demand. However, when the Federal Reserve shows up with an infinite jug of water, it can just keep dumping money in, and it basically overflows and spills everywhere. And that's what's happening with quantitative easing. To keep the economy propped up, the Federal Reserve is purchasing assets with money that didn't exist prior in circulation, therefore causing all asset classes to inflate. How I like to explain this is, imagine you're an investor and you don't want to hold cash. Everyone knows holding cash is bad because of inflation. But where do you want to put your money? You have lots of options, but there's government bonds, corporate bonds, real estate, commodities like precious metals or gold, crypto, or the stock market. Now, when the Federal Reserve says, hey, I have infinite money and I'm going to buy up all the government bonds and a lot of corporate bonds, $120 billion a month, and they're willing to drive down the yields, the interest rates that you should be receiving to entice people to buy those bonds. Because they're driving it down, other investors have to go elsewhere to find a higher return on their money. So if the Fed shows up and says, no, we want the corporate bonds, we want the government bonds, your money's no good here, you're not going to beat inflation buying government bonds that only have a 1% yield. What this is doing is it's forcing people with money, it's forcing investors to go elsewhere. So where are they going? They're going to real estate, they're going to commodities, they're going to crypto, they're going to the stock market, which is why the stock market, the real estate market, the total crypto market, and the commodities market are at all-time highs. It's because money that the Fed is pulling out of nothing is soaking up the $46 trillion total bond market, and investors are being forced to go elsewhere. This chart shows the Federal Reserve's balance sheet over time. You can see prior to the 2008 recession, they only had about $1 trillion worth of assets on their books. However, they quickly purchased a lot and gradually increased through quantitative easing until around 2015. Around 2015, unemployment was seen as good, the economy was healthy, so they started raising interest rates and they stopped buying securities. You can see between 2015 and 2018, they didn't buy anything. And in this time period, the economy was good. The stock market was still going up between 2015 and 2018. Unemployment was relatively low, so they didn't feel like they needed to inject more money into the economy. And their balance sheet actually started going down. However, late 2019, looks like they started buying again, and then of course the 2020 March pandemic collapse, and looks like they immediately purchased $2.5 trillion worth of assets. These squiggly lines going up from there is the additional $120 billion a month that they're buying in US Treasuries. So what's going to happen when the Fed tapers? This article, there's growing support within the Fed to announce the tapering of bond purchases in September. Why is this? It's because inflation is really high. It's like 5.6% right now. So it's going to cause a shock through all investments, all asset classes basically. If the Federal Reserve stops buying corporate bonds and government bonds, and normal market forces drive the yields up, it's going to entice investors to start buying them again. So if the Federal Reserve tapers and stops buying, then there's going to be a reverse effect where money is going to flow back into corporate bonds and government bonds. And that money has to come from somewhere. If there's a finite amount in circulation amongst all investors, then we're going to see a decrease in the real estate market, commodities, crypto, and the stock market. And this is what has everybody panicked. Just the idea of talking about tapering is enough to cause people in these other asset classes to say, oh no, there's going to be a decrease in value for these assets. I'm going to be the first one out the door, basically. So anytime the Fed talks about tapering and the reduction in the amount of bonds they're buying, there's a sell-off in the market because people are saying, the easy money is going to end soon, so I'm going to be the first to sell and then obviously buy back in when the market goes down. Former Fed Chair Ben Bernanke said in 2014, the problem with quantitative easing is it works in practice, but it doesn't work in theory. Kind of a funny quote. And when you think about it, yeah, we're doing it. It's keeping the economy propped up. Everyone's happy with the easy money. But the theory is it has to end. And what happens when it ends? How does it play out when the Fed tapers and stops quantitative easing? And they have to come up with a plan. It's one day at a time, I guess. But the problem is inflation. If your salary goes up 3% this year, but inflation is 5.6, well, you're losing money, even if you're working hard. So what they can do to taper and reverse quantitative easing, the first one is they can increase interest rates, the amount that commercial banks borrow from the Fed. And I just don't see that happening anytime soon. Whenever the Fed meets, they always say, well, in 2023, we're going to start raising interest rates. And I just don't see that happening with given the fact that it was basically at zero for 8 years after the 2008 recession. So I don't think they're going to raise interest rates in the next couple years. The second thing they can do is slow or stop the buying of bonds. Do they have to completely stop? No. But do they need to be buying $120 billion a month? Also no. So they could reduce that to just 100. They could slowly draw it down month to month, go down to 80 billion a month, 20 billion a month, whatever, until they can get down to zero. I think that's the most likely option in the immediate future, is just stop buying bonds. That seems like the most obvious thing, and that's something they can do starting in September. And when they do that, yep, it's going to be a shock to the stock market because investors aren't going to be happy. The third option they can do is sell securities they have on their books. On the secondary markets, if they've already purchased corporate bonds or government bonds, they can unload them. They can find people willing to take it off their hands. And by reclaiming that money, they're basically removing it from circulation. I don't see them doing this because I don't know if they've ever done it. When you look at this chart over time, it actually tells you a lot. So when you look at 2008, when they initially started purchasing government bonds through quantitative easing, did it ever go down? Well, it started going down in 2018, meaning that if they were buying 10-year Treasury yields in 2008, they were maturing, they were expiring in 2018, and they just weren't renewing them. So what I could see the Fed doing is everything they bought, if it's a 30-year bond, a 1-year bond, a 10-year bond, they're just going to hold it until the bond matures and expires, and then they're not going to repurchase it. They're just not going to renew it. But I don't see them unloading whatever they have on the book in the secondary market, when first they can stop buying and second they can raise interest rates. So unloading what they have on their books, I see this being their last resort. And in the background, what's really playing out here is a careful dance to make sure that the 7.5 million people still using those extended federal unemployment benefits, they want to these are ending at the end of this month, and they want these people to rejoin the workforce. I don't know about you guys, but every place that I go into is currently hiring, and they need these 7.5 million people to get back to work. And you can't blame them. When you give people free money, they're going to max it out and stay home. Obviously, childcare with kids not being in school is a huge concern, which is why they chose September for these unemployment benefits to end. But this was the strategy. The federal government said, to fight this pandemic, we're going to pay people to stay at home. And stay at home they did. However, the economy is roaring back. Everybody's doing business. And if these people can just get back to work, it would help the case for tapering. So there you have it, guys. Everything you need to know about tapering as it relates to the Fed and the stock market. If you enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, I'll help you out if I can. Let me know down below. Till the next video, take care.